So as academic moderator, I have a job of taking this through amazing papers and trying to put them together, which I will try to do in about a second. But I'm very grateful to this amazing authors putting it together. I'm also very excited to be moderating this particular session because the deposit runs and everything that is happening in deposits was on a backdrop for a long time, more than a decade, because we were at a very low interest rate environment, very stable interest rate environment. We're not really worried about it. And then the disaster happens, and all of this kind of is elevated to the top of our mind. And I would like to use SVB as a lens to present these three papers in succession, because everything seems to be perfectly fine with SVB just before the disaster hit, right? Everything, all the reports were satisfactory, 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 some minor weaknesses, but generally satisfactory. And then we can say the disaster hit, but reality, it was not kind of a disaster hit. In reality, the stock price for SVB was declining for quite some period of time. It's just the final blow was a perfect storm. And if you want to think about this SVB perfect storm, there were a lot of components to this perfect storm, okay? I'm going to go through them one by one, just to relate those components to the papers that you just heard about. So for one, right, SVB experienced this enormous growth in deposits over the years. So this is essentially over 2.5 years, and you can see how the deposit base just exploded, right? With that start of a decline in 2022, but essentially it's exploded deposit base. And then what did they do with these newly found deposits? Actually, they put them in securities. Not only they put them in securities, they put them into held-to-maturity securities. And if you dig deeper, they kind of put them in this high-risk, higher-yield securities. And if it sounds a lot like Michael's paper, that's exactly what I'm trying to bring the analogy here, right? And why did they did not put it into credit? Because the type of loans that they were doing were quite unique. They were working a lot with private equity venture funds, and they were providing the loan facilities. And those were not in demand in that 22 because the market slowed down and everything was kind of in a state of suspended animation in this space, right? And then the interest rates started hiking up, right? And the two effects collided in that perfect storm at the same time for them, because one effect that obviously all this held-to-maturity securities that were long-term RMBS, CMBS, they were very sensitive to the interest rates, right? They started declining in value, but the more important factor that affected them is the fact that deposits started flowing out. And it's not unique to SVB. We've known it for a long period of time that deposits are actually countercyclical, right? So what this graph you can see is that when that dashed black line or federal funds rate actually goes up, we experience outflow of deposits. This is a systematic factor. This is the beauty of banks, that when we need deposits to lend to sustain economic growth in the downward cycles, we have the deposit inflows to lend, right? When we need to slow down the economy, the deposits are actually flowing out because the interest rates are out there much more attractive. So, and of course, what happens when those two forces collide, you have to meet the deposit outflows. How you meet the deposit outflows, you have to sell some of the assets on your balance sheet. You sell held-to-maturity securities, you incur a loss, and they go out on that March 8th with a statement, we need to raise more equity. Oh, and by the way, we lost $1 billion plus in assets. Nothing to see here, really. I'm going to leave them to deal with their banker on what they're going to do about this particular thing. But that happened on March 8th, right? And on March 9th, social media picks it up. And on March 10th, 42 billion of deposits are flowing out, right? So it's a perfect storm of events. And that is, in that perfect storm of events, I think the biggest question for the policymakers is, okay, what are these components of this perfect storm? Are really just one in a lifetime kind of a storm? And what are the components that are systemic in nature? What is the likelihood we're going to see it again, right? And what these three papers do, they're kind of attacking 3 of those 5 components and I put on the slide, right? And the 2 they're kind of keeping in the background. So in Michael's work, this dynamic deposits, the rollover inflows, there's the big question. So what if you have a bank that has this big inflow of deposits into a bank balance sheet, right? Just mechanically, equity ratio is going down. Equity ratio is going down. What are you going to do? Because you cannot really lend it. You don't have enough equity to continue lending, right? So one option is you're going to raise more equity. What they are arguing is that that's not the preferred option by banks in a systemic kind of in a regular fashion. What is the better option? We're going to increase our risk in our asset side of the balance sheet, right? We're going to jump up our ROA. That's going to contribute to the equity capital. We're kind of going to slowly go to high capitalization, and it's all going to work. Sounds great, right? So what do they find is that banks that experience deposit inflows, they risk shift, they reach for yield, they subsequently experience loan losses, right? They increase risking of assets. And this effects are stronger for undercapitalized banks, right? Because the incentives to go for that is much stronger. So my only kind of two questions here is that, do unexpected deposit inflows really exist? I'm only aware of one, when the fracking shock happens and people were bringing $1 billion checks to the bank, right? But does this really exist? And the other thing is that they touch on it a little bit, but how does the business cycle feature into this? Is does the business cycle, going back to Tony's words, catalyst, conduit, like how is this happening? So if we think about this big deposit inflows, right, it's hard to allocate it to lending. Most likely it's going to be allocated to securities, and that's where the second paper comes to mind, thinking about where is the securities are going. Is it available for sale, held to maturity? Is it kind of disguised losses? So, and I think the author made a great presentation to you, and essentially the bottom line here is that, look, when you have low interest rates, right, they have very unique empirical setting, but if you have low interest rates, there is an incentive to allocate securities to available for sale that allows to recognize gains. That's all beautiful and great. The moment the interest rate starts hiking up, what do we have? We have this reallocation to held to maturity, right? And the author showed very lovely that when the regulators step back, the behavior changes a little bit. Reminds me a little bit when the cat's away, the mice can play. But apparently the mice can play all the time. It's just they play different games when the regulators are watching very carefully and when the regulators are not really watching, right? That creates kind of all the mindset that this differential between available for sale and held to maturity is not only there for accounting purposes. There is some risk embedded in this. Right? So what lesson can we learn from this finding? The authors take a very bold kind of statements that finding provides support for recent calls to eliminate held to maturity category and AOCI filter. But for me, we have not thought through, like this is a great finding, great setup for us to explore it further and think about what are the implications of this. Like, can we just easily part with the available for sale held to maturity? What are the costs to it, right? What does this allocation between available for sale does beyond just securities? And more importantly, banks' balance sheets already offer quite a bit of insights for potential losses that are unrealized. Right? Why is it not enough currently for regulators or for investors? What do we do with this? But again, it's a great way to think that the allocation between available for sale and held to maturity tells us a lot about the concerns for banks and their ability to withstand losses today in terms of equity capital. And that leads us to third question. Third question, that once those two sources collide, right, and again, those first two papers are showing that those two forces are there on a much more systematic fashion that we previously believed, right? What does it take to get to a run? What does it take to a crisis, even for one bank, right? Can social media actually play an important role here? Because I've heard quite a bit about the risk affiliated with the cybersecurity. I think in a year or two, we're going to see more and more risk associated with social media, especially given the environment where more and more of your depositors and your borrowers tapping social media for news rather than newspapers or official websites, right? So the answers that Tony and his co-authors offer us is that social media amplifies investors' and depositors' reaction to bank balance sheet kind of weaknesses. that this negative sentiment in social media during this period of run, during the post-SVB period that we experienced, translates into immediate shock to the stock price, right? And this is even more so for banks that have underlying weaknesses, meaning banks that have more losses kind of accumulated on the balance sheet from the held-to-maturity securities, and also banks that are exposed more to the retail depositor, to the insured depositor, right? Their results that pertain to deposits specifically are slightly weaker, but there is a reason for that. Okay? So this paper, what it recognizes very importantly, that not all the evidence is SVB. Yes, there was a lot of conversation about SVB in the social media, but what they're relying on, very importantly, is a lot of conversations about other banks. That conversation about SVB catalyzed. And what they're exploiting is actually less SVB-related tweets, but the tweets pertaining to other banks, and whether those tweets actually led to the stock losses. So, and their evidence is beautiful that, yes, that the negative conversations online about banks leads to stock price declines, significant stock price declines, right? So the question for me is that the title actually calls us to think about bank runs, and bank runs are deposits. But most of their evidence is about stock returns. And this is a shot not across the author's bow, because there is nothing they can do about it. This is actually a desperate plea. Very desperate plea. Because in the world where we care about the deposits, and in the world where it becomes very important for the stability of the financial system, we researchers cannot inform policy because we cannot do research due to the lack of data. So why social media? The other question that I have is why social media only amplifies outflows of uninsured deposits. But the total deposits remain unchanged in their paper, meaning there is this reallocation from uninsured to insured. So meaning our depositors are so smart. I'm taking money from one bank that are in excess of 250 and depositing to other bank or depositing to other account. This is just a little bit strange for me. And that goes back to, dear regulators, can we actually fix the issue of not estimating insured and uninsured and actually have the real number? Because that actually prevents us from informing policy in the right way. So the last thing that I would like to kind of ask here is, do tweets carry this informational content, and was the investor reaction rational? So I think that's a very important question for us to think about. And again, not the shot across the author's bow, it's for the future research. And the reason is that right now, it seems like in the economic environment, a lot of banks are really worried about runs, irrational runs, where social media can be a very strong catalyst, right? And thinking about, do depositors actually react to irrational information is very important for us. So to conclude, SVB catalyzed a lot of, I think, very important questions, right, for both the industry, the regulators, the academic, right? So, and these papers, I think these 3 papers for me are saying that at least out of the 5 forces that I've highlighted, they touch on 3 and they show, no, it was not kind of a perfect storm of once in a lifetime. There is more systemic evidence that those forces are riding in the background and they will collide again, which means that it's very important for us to pay attention to this. So I'm very grateful to these authors to putting it together. And thank you for listening to this. And I'm going to pass the baton to our discussant from the President and CEO of City National Bank and City Holding Corporation, Charles Horberg.